Unit 6, Bonds, Lecture 1, Introduction to Bonds. Bonds are long-term, fixed obligation debt securities. They are long-term because they issue for 10 years or more. They are fixed obligation because once a bond is issued, the issuer is obliged to continue payments until it matures, and they are debt securities because the issuer is borrowing funds. The issuer agrees to pay or is obliged to pay a fixed amount of interest periodically to the holder of the bond, and usually bonds are issued with coupons paid semi-annually, coupon being another name for the interest. The principal or par value, also known as the face value, which is equal to the total amount that is borrowed, will be repaid at maturity by the issuer, and the par value is rarely less than R1,000,000 here in South Africa. The public debt market is divided into 3 time segments. There are the short-term debt instruments or money market instruments whose maturities are less than a year. There's the intermediate term, referred to as notes, with maturities of 1 to 10 years, and long-term bonds have maturities of more than 10 years. Now this is an example of a bond that was issued in South Africa, and it will contain the name of the issuer, the coupon percentage that will be paid, the principal amount that is going to be borrowed, the frequency over which the coupon will be paid, so whether it will be paid annually or semi-annually, and the date on which it matures. There are different types of issues for bonds, and this is based primarily on the amount of security that the bond is issued with. You have secured or senior bonds, and they are backed by a legal claim on a specified property of the issuer in case of default. What it means is that specific assets are set aside which actually form the collateral for this bond. For example, in mortgage bonds, property or real estate assets are the securities. So if the issuer defaults, that particular asset can be sold off to cover the debt obligations for the issuer. With unsecured bonds or debentures, these are backed only by the promise of the issuer to pay interest and the principal. And here, the creditworthiness of the issuer is of paramount importance because there is no collateral to back this asset, to back this debt, I should say. Another type of bond issue is the subordinate or junior debenture. They have a claim on income or assets that is lower than other debentures, so other debt gets paid first, then these debentures receive what is left of the income. Now, income bonds and revenue bonds fall under this category. Income bonds are bonds where only the principal or par value is guaranteed to be returned to the investor. If the issuer does not generate sufficient revenue, they don't have to pay interest. Now, revenue bonds, these are bonds whose funds are used to fund specific projects. And if a minimum amount of revenue is not generated from that project, then the issuers can either delay or avoid making interest payments. Now, finally, we come to refunding bonds and sinking fund bonds. A refunding bond is an issue which provides funds to retire another issue. So it's a specific amount of money that is set aside by the company to retire an existing bond issue. A sinking fund bond, that's a bond where the capital or par value is redeemed over the life of the bond rather than only at maturity. So a schedule is set up and a certain percentage of the par value is redeemed each year over the life of the bond. Now, the size of the sinking fund can be a percentage of the total outstanding debt for the issuer, or it can be a percentage of a specific issue. When I come to terminology used for bonds, it's quite important to know this. It will come up time and time again, particularly in the valuation of bonds. There is the coupon. This is the interest that is payable over the life of the bond, also known as interest income, and is used to calculate the nominal or current yield on the bond. It's called a coupon because in the old days, when bonds were first issued, they were bearer bonds. So the bonds did not contain the names of the individual investors. So whoever happened to have this bond in their possession was the official owner. And the bonds came with coupons for the interest payments. So if you tore out a coupon and presented it to the issuer, you would receive that particular interest payment. The coupon frequency is the number of times within a year that interest is payable, and usually bonds pay interest semi-annually or twice a year. The term to maturity, this refers specifically to the number of years before the bond matures. The principal or par value, otherwise known as the face value, is the original value of the obligation. Essentially, it is the amount that the issuer of the bond borrows. It remains fixed, does not change, and is the amount of money that is returned to the investor when the bond matures. It is used to determine the current market value or market price of the bond. The yield to maturity is the total return anticipated on a bond if the bond is held until it matures. It is a long-term bond yield but is expressed as an annual percentage rate. The assumptions embedded in it is that every coupon that you get paid is reinvested at the yield to maturity.